that tariffs all along have been sort of a convenient distraction from the main issue. And, I wrote a piece back when Trump first debuted his tariffs and the markets got all hysterical about it, called scapegoating. And, the idea was that this whole tariff drama was going to steal headlines away from the main issue, which of course is our runaway fiscal situation and specifically how we're going to be able to finance these deficits, which is why I continue to focus really intently on the 10-year Treasury yield. And it's not just me that's focusing on it. Scott Bessent long ago basically said, our focus isn't on the stock market. That's not how we're measuring our success or failure. It's the direction of the 10-year Treasury yield. So right now he's got to be rather disappointed that he spent the weekend cobbling together this 90-day ceasefire and the 10-year yield backs up. Now, arguably, you would say that's because people are anticipating stronger economic growth, and that may be the case. But the fact is that the 10-year yield has been really recalcitrant. I'm going to, use one of my SAT vocab words, but it's the perfect one to describe the action in the 10-year. Long rates just really have been stubbornly high, and that's an issue for an economy as levered as ours, not just for the government financing, but the corporate sector, which has a tremendous amount of debt to roll this year and next year and the year after that. Yeah, well, I don't think the stock market's going to be able to ignore it for long. I mean, this is just a giddy celebration on the tariff headlines. But generally, everyone, I think, understands that raising the cost of borrowing in an economy as levered as ours is a major issue. We've seen, corporate debt service has doubled since the Fed started raising interest rates when it first started tightening back in 2022. So we've had the largest companies in the country, the S&P 500 companies, their debt service has doubled over that stretch. And you can only imagine what the picture looks like for the smaller cap companies beneath that. If you broaden the lens out to the Russell small caps, and if you even look into the private credit space, and obviously it's very hard to get data on that, but there's some work that I've seen recently that suggests that, interest coverage ratios in that area have really deteriorated in just the last couple of years. So higher rates are an existential problem, not just for the federal government again, but for the corporate sector. And to put numbers on it, there's $1 trillion in corporate bonds that have to roll this year, and then 1.2 trillion next year, and it's another 1 point something or other trillion in the year after that. This is why when the administration came out and really proposed this big economic reset, which is really not just a reset for the U.S. economy in terms of revitalizing domestic manufacturing production and bringing supply chains home, but obviously it's a reset for the world, whether they want to participate or not, they're going to have to. But that economic reset in trade has to coincide with some kind of plan for how you're going to finance the deficits. Because basically, if you're saying the US consumer isn't going to be the consumer of global goods and the rest of the world can't just rely on exporting all kinds of cheap stuff to us, then the necessity for them to recycle dollars from selling those goods to the US consumer obviously diminishes as well. And if that goes away, that's been what sustained our deficits, is that we've had this sort of vendor financing quid pro quo in place for decades now, where, it was kind of a good arrangement, or it appeared to be, for US consumers got cheap goods. The rest of the world was able to boost their growth by having strong export sector. And then they would take those dollars and basically lend them right back to us by buying our US Treasury debt. So basically what they're resetting isn't just trade, but they're resetting the entire dollar reserve dynamic. And I think that part of it hasn't gotten the attention or focus from the markets, and it also hasn't been articulated by the administration. I mean, what is their game plan for that? How do they intend to finance these deficits? And I think the answer right now is they are hoping that some combination of savings from Doge and tariff income and then growth, if they can get these tax cuts through and stimulate some real growth in the economy, they'll generate enough revenue to help bring down the deficit. But that's a lot of ifs. And, time is of the essence. In the meantime, we've got to figure out who's going to buy $2 trillion worth of paper. And as you said, the banking sector, I know they're talking about changing the leverage ratio for the banks possibly as a way to allow them to free up more funds to buy treasuries. Do you really want to have the banking sector lending to the federal government? Isn't the banking sector supposed to be lending to the private sector? And if they're lending to the federal government, then who's going to lend to the private sector? It just seems like that's not really the solution to this problem, which is why, as you and I have talked about before, I always come back to the Federal Reserve as the only obvious candidate to absorb all this issuance. Well, I think we got a little glimpse of a potential accident with this unwind of the basis trade, which has been really enormous and ongoing for years now, and actually is one that the Federal Reserve has flagged as a potential source of dislocation in the financial market. And I think it's not an accident that they started to taper the quantitative tightening way back, several months ago, and now have accelerated that taper as the Treasury market has really refused to come to heel. And Secretary Bessent acknowledged that there was some issues around the unwind of leverage associated with the basis trade. So I think the good news is that he, obviously being a Wall Street, very successful hedge fund manager, understands the dynamics of what's happening in the Treasury market and is mindful of it. But even he sort of poo-pooed that as just a few players getting overly levered and now having to unwind their positions. But there's still the larger issue of how we're going to finance all this paper. And you alluded to T-bills and what's happening there. And, one of the things that's kind of created a problem for us is that Janet Yellen decided to finance these $2 trillion deficits with T-bills. So something like north of 80% of our Treasury issuance was Treasury bills, which meant that, basically she was gambling that the Fed was going to cut rates so she could borrow cheap. And then a year from now, when she had to refinance, she'd be able to do it at lower rates. And of course, that turned out not to be the case. Since arriving on the job, Scott Bessent hasn't made any changes to the structure of issuance as yet, which is a pretty powerful indication of how challenging the situation is, because he was very outspoken against this sort of reckless financing with T-bills. But he obviously is sort of struggling to figure out a way around that, since again, we're facing an environment where yields are just stubborn. And if he doesn't continue to finance at the front end, interest expenses is going to be a lot higher. I think the most important message of the headline is that they were able to agree on a pause. And so that suggests a little less stubborn a stance on the part of China, that maybe you see, there's a lot of speculation about, his popularity and his ability to maintain a power. The economy there is obviously really struggling. And so the last thing he needed was this. So the fact that they were willing to come to the table and come up with this agreement is very positive in that regard. But in terms of the actual substance, we'll have to wait and see what happens, 3 months from now when the pause is over. If you go back and look at Trump's first term where he imposed tariffs, you may recall they put on the tariffs and we had all the same, tariffs are a tax on the consumer and inflation's going to go to the moon kind of headlines. And it turned out that both the CPI and the PPI were lower 12 months after they put the tariffs on than they were at the time they were imposed. So clearly it was not a tax on the consumer. And the reason why is that China and the Chinese exporters took the hit. They absorbed the tariff so as to maintain market share with U.S. consumers. And they did that in 2018 when their economy, albeit not in great shape, was in vastly better shape than it is today. So, this is just speculation, but my sense is if they were willing to absorb the hit back in 2018, they're probably even more inclined to do so today. And again, with Xi's kind of tenuous grip on power or whatever, I'm sure he doesn't have a tenuous grip, but he's got issues. His propensity to try to figure out a solution is probably a lot higher. So I don't worry about the inflation standpoint of it. But again, the thing that I worry about is how do we answer the question of the financing of our deficits? Because obviously, if China has no reason to be buying our treasuries, we have to come up with another buyer. Toot sweet. I guess they're definitely in a box because you do have inflation pressures that are higher than you would expect them to be at a time when the economy is slowing. And you look at those consumer confidence and sentiment numbers and business sentiment and CapEx plans and all of this, you would expect inflation to be much softer, and particularly in the commodity space. And I know there was a big celebration about oil getting back below $60 a barrel. Well, if you blinked, you missed it, because today we're back up to 62. So it does seem like those pressures are not going to abate. And that's a problem for the Fed, as you mentioned, at a time when it's clear that the employment picture is deteriorating. But I think that his modus operandi right now is largely political. I hate to say that, but when you look back at the rate cuts in September and compare the economy then to the economy now, the case for cuts right now is substantially better than it was in September. So that's not a question that any of the journalists in the room happened to ask him last week. No. But, if you look at just simply nominal economic activity, nominal GDP growth, and consider that generally long-term rates should equal the growth rate of the economy. Like generally, if you've got 5% nominal growth, you should have 5% interest rates, and that would be a neutral rate. We've had an environment where growth has slowed down toward 4%, and now Treasury yields are backing back up. So we're about to reach that point where the 10-year is telling you that the Fed is too restrictive. And I think actually Scott Bessent made a point to that effect, although I think he was talking about more shorter maturities, but it's essentially the same thing right now, that the Fed is just too restrictive, and that's what the bond market is telling you. Now, Trump inadvertently has put Powell in a position where if he does cut rates, it appears like he's caving to the administration. And so that sets a very high bar for him to do anything, which is the exact opposite, I think, of what Trump was hoping to achieve. But, he's really set this up where Powell is trying to demonstrate that he's got a spine. And the only way to do that is to resist cutting rates regardless of what the data says. But you're so right. The credit stress is there. The interesting thing, though, that's been enormously frustrating to me is that the credit stress is there when you look at bankruptcies and the sort of distressed debt exchanges, the rate at which that's happening in the credit markets. But when you look at headline credit spreads, they've moved up during the risk off thing, and now they've come back down. They've recovered a fair amount of the blowout in spreads that we saw prior. So this risk on attitude seems to just ignore what's going on in terms of the actual fundamentals for a lot of these economies. And it may be that they're really betting on earnings accelerating. Maybe it's a bet both that the tariff situation will resolve in a favorable way, but also we'll get this big, beautiful bill with the tax cuts. And that will provide some extra wherewithal for the corporate sector to withstand the higher interest rates and service their debt. So I don't know. I can only speculate, but it is frustrating because you clearly see, the worst bankruptcies basically since the Great Recession outside of COVID, and credit spreads that don't really reflect that yet, I would say, but I think they will.